Franklin India Dynamic P/E Ratio Fund of Funds. There are two ways in which investors can diversify across asset classes like equity, debt, and gold when they invest through mutual funds. 1. Choose and invest in individual funds in the proportion of asset classes matching one's risk appetite. For example, higher equity allocation for if one has a higher risk appetite. Or 2. Invest in a mutual fund which offers a combination of asset classes in a single fund. For example, a single fund which invests 60% of the money in equity assets or 40% of the money in debt assets or vice versa. Such funds are called hybrid funds. In this video, we look at hybrid funds which offer a ready-made diversified asset allocation combination to investors, thus avoiding the hassles of rebalancing asset classes on their own. Hybrid funds offer different asset classes either as a portfolio of stocks or securities, or as multiple funds within a fund called a fund of funds product in the stated proportion of asset classes. Why invest in hybrid funds? Financial prudence advocates that an investor must invest across asset classes to achieve diversification. This can be done via asset allocation. Diversification helps lower the risk in a portfolio, as no two asset classes generally move up or down at the same time, and this in turn aims to provide higher risk-adjusted returns. Asset allocation in a hybrid mutual fund moves as per the mandate mentioned in the offer document. One can allocate across equity and debt mutual funds manually, but this requires one to regularly monitor the allocation and rebalance it periodically to the original asset allocation. For example, if the asset allocation was a 60-40 debt-equity mix and it changes to 70-30 after 1 year due to market movement, one needs to sell debt or buy more of equity to bring the ratio back to 60-40. This is called rebalancing. While rebalancing across individual mutual funds, it is also important to check for exit loads and tax implications in case of redemptions. However, in case of hybrid funds, there is no impact of exit load and tax when the fund manager rebalances the allocation. Hybrid funds offer a ready-made asset allocation combination wherein one can either choose a static or range-bound asset allocation, like a balanced fund which has a higher allocation to equity, or a monthly income plan which has a higher allocation to debt. Or B, a dynamic or a variable asset allocation, which uses a formula or strategy like, say, price-to-earning ratio to allocate across asset classes. These funds swing between an equity orientation to a debt orientation depending upon the value of the formula. Why does a combination of asset classes work? In this table, you will realize that the same asset class does not always give the best returns. Sometimes it is equity, sometimes gold, and sometimes debt. However, it is difficult to predict which asset class will do well year on year. One needs to therefore invest in a combination of all asset classes to reduce the risk of underperformance in one asset class. As per this table, a combined or a hybrid portfolio may not have provided the best returns, but has also not provided the worst returns and has stayed on a middle path. A hybrid fund thus helps to follow the middle path. Let's look at the key benefits of investing in the Franklin India Dynamic P/E Ratio Fund of Funds. This is an open-ended fund of funds scheme which seeks to provide long-term capital appreciation with relatively low volatility through a dynamically balanced portfolio of equity and income funds from the Franklin Templeton India bouquet. It has a unique inbuilt buy-sell discipline based on market valuations to ensure there is less room for subjectivity or error of judgment. This is done through a predefined monthly rebalancing mechanism based on P/E ratio of the Nifty 50 index by reducing equity exposure and increasing debt exposure when P/E levels are high and vice versa. What is the P/E ratio? P/E stands for price earning. This price earning ratio is the price of a share for every rupee earned by the company. The latter is the profit after tax, PAT, per share. For example, a company with a stock price of 60 rupees and earnings per share of 3 rupees will have a PE ratio of 60 divided by 3, that equals to 20. Just as it's always good to buy a stock at a lower price and sell at a higher price, this rule also applies to a PE ratio, which is used as a trigger to increase or decrease equity exposure. Accordingly, one can increase equity exposure when the PE ratio is low and reduce exposure when the PE ratio is high. Buying more equity when the PE ratio is low helps to gain when the market rises, and reducing exposure when the PE ratio is high helps to cushion the fall when the markets peak. One can use the historical PE ratio of the benchmark index during bull and bear phases to estimate whether current market valuations are high or low. The PE ratio is thus an easy and objective method of allocating between equity and debt during market cycles. Now that we know how a PE ratio works, let's understand how it is used by the Franklin India Dynamic PE Ratio Fund of Funds. Table shows how the fund increases equity exposure when the PE ratio is low and reduces it when the PE ratio is high. The equity exposure will be updated every month based on the weighted average PE ratio of all the 50 stocks in the NSE Nifty index. For example, if the weighted average PE ratio is between 12 to 16, then the equity exposure would be restricted to 70 to 90% of the portfolio assets. The final number within this range is left to the discretion of the portfolio manager. Thus, the fund provides investors a ready-made, auto-adjustable and diversified asset allocation between equity and debt. This graph indicates how the equity exposure in the fund changes with the change in the PE ratio of the Nifty 50. It also indicates that a higher allocation to equity when the PE ratio is low helps the portfolio gain when the market rises. A lower equity exposure when the PE ratio is high also helps to cushion the portfolio if the market falls from a peak. What are the key benefits of investing in this Franklin India Dynamic PE Ratio Fund of Funds? It invests in the equity component in Franklin India Blue Chip Fund and the debt component in Franklin India Short-Term Income Plan. It follows a dynamic asset allocation strategy which will balance asset allocation every month based on weighted average PE ratio of Nifty 50 index stocks. In case equity allocation reaches 20% of the Franklin India Blue Chip Fund corpus, then equity allocation will shift to Franklin India Prima Plus. In case debt allocation reaches 20% of Franklin India Short-Term Income Plan corpus, then debt allocation will shift to Franklin India Income Opportunities Fund. Ideal investment horizon. Since the equity component can swing between 90 to 100% range and the 0 to 10% range based on the PE ratio, the fund can be predominantly equity-oriented fund or a predominantly debt-oriented fund basis the allocation. Hence, we recommend a longer investment horizon of 5 years or more which suits both an equity and debt-oriented fund. Equity funds tend to display volatility over shorter time periods. But when one invests for longer periods of time, that volatility factor tends to get negated. Every investment you make must ideally be linked to a financial goal, and this goal could be of varied durations depending upon your investment needs. Since the fund is recommended for a 5 years or more investment horizon, it is ideally suited for planning for your long-term financial goals, such as planning for your child's higher education or marriage, building a retirement corpus, or even if you are seeking long-term wealth creation. Who should invest in this fund? Those with a moderately high-risk profile and are looking for a ready-made diversification across key asset classes. Also those who want equity growth but seek to cushion market volatility with a debt exposure. This fund helps to invest across key asset classes like equity and debt through a single fund which automatically allocates among these components using the PE ratio formula. Let's take a look at the tax structure of this fund. Liquidity. You can redeem your investments in full or in part on any business day. The redemption amount is normally dispatched within 10 working days from the date of redemption. You could either receive this amount as a direct credit into your registered bank account or as a physical check which you can deposit into your registered bank account. What more do you need to know? Let's get to know some fund facts of the Franklin India Dynamic PE Ratio Fund of Funds. For more information, please feel free to contact your mutual fund distributor or registered investment advisor. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.